I hope everybody had a happy, healthy, and safe Thanksgiving, and certainly a joyous holiday season as it is coming up over the next few weeks. Today, I am your only speaker. You are lucky. So, without further ado, guess what? Today, we are not talking about GASB 87. Even though GASB 87, as well as the American Rescue Plan Act, are burning up my phone and email every single day, it seems like. Folks, there's a world beyond GASB 87, and certainly next year, to give you some flavors of what we're going to talk about during next year's webinars. Yes, we'll jump back into GASB 87 because that seems to be my life, like I say, along with the American Rescue Plan. But today's agenda is going to focus first on some quick hits from the GASB that are easy for most of us. I mean, really easy. The first bar up there, GASB Statement number 98, GASB Statement 89, and GASB Statement number 93. For you December year-end governments, those are your implementations for this year. For many of you, you can pretty much, hit the checkbox and you're almost done. It really depends on the structure of your government. I'm then going to give you a sneak peek on what the new auditor's report will look like. I was just talking with a elected official, and I mentioned, I said, the auditor's report is changing in less than 2 weeks. And he said, really? And I said, yeah, it is. It's changing. And sure enough, I'm going to show you what it's going to look like. Yes, things are changing for the auditors as well as preparers. And so just to give you a sneak peek of what that's going to look like, starting off on December 15th of this year, and given the fact it's December 2nd, yes, less than 2 weeks. Then I'm going to turn the calendar to 2022 beyond GASB 87. We have 3 other standards to think about beyond GASB 87, one of which I talked about extensively last spring, but then we kind of forgot about it. And last year, because last year we did a lot of webinars on GASB 84 and GASB 87, and we'll revisit GASB 97 a little bit, which we touched upon during May of this year during a webinar, but we'll revisit it a little bit. And I think we also touched upon it in September. But for those of you who did not implement GASB 97 early, this year is 2022 is your year. Finally, I'm going to peer into the crystal ball and see the ghost of Christmas future to allow you to plan for the next year's holidays. And hopefully we'll have some time for your questions before we wrap it up. What does the calendar look like for December 31st year ends? This year, easy to take, but with a caveat. Now, GASB may change Statement 93 with the pending Omnibus standard that I'm going to talk about later this session. The board is meeting coming up the week after next. It's unclear what'll be on the agenda, but I know that they're watching things closely with regard to the investment market gyrations, which have been going on over the past couple of weeks. For those of you who are stockholders, you saw what happened yesterday where the Dow fluctuated 900 points in a day. And so there's a little bit of volatility what's going on now. Obviously, Libor doesn't have much to do with the stock market, but overall, the financial markets are a little bit in a tizzy right now because of COVID. So again, not too tough to take for this December year end. 2022, other than leases for some governments, conduit debt may be a pretty big deal for governments. Now, going into 2023, we then expand on the lease framework into GASB 94 and 96, and I talked about those in September. But then we have 2 pending standards. We may know over the next couple of weeks certainly by the end of the year, about the final language in what will probably be GASB 99 compensated absences, unless it's delayed by some ongoing deliberations. There are a few sticky points that the board is going to be discussing over the next couple of weeks. By the spring, GASB will hit the century line with the Omnibus standard. That will have some impact into 2024. And finally, the GASB last week started redeliberations on the proposed accounting changes and error corrections. That final standard may not be released until this upcoming June, but it'll likely be GASB 101. That's a great name for a class. GASB 101. All right, so what's in our bag of toys this year? Let's just start off with an easy one, GASB Statement number 98, the annual comprehensive financial report. Now, this is easy for preparers, certainly a little more difficult for auditors and not so easy for the GASB. But for the preparers on the call, this really only applies to those of you who prepared or want to prepare comprehensive annual financial reports. That's it. It does not apply to those governments who prepare just annual financial reports or maybe just fund statements or special purpose reports and things like that. It only applies if you prepare the comprehensive annual financial report. It is effective this year and forward, so pretty quick turnaround for you December year ends. For preparers, GASB 98 is really simple to implement. I put on the screen here a bunch of do's and don'ts. Do a search for not only the phrase comprehensive annual financial report, though, but also look at your website and within the annual financial report, the notes to the financial statements. Take a look for the abbreviation or acronym. And I got a couple of draft annual financial reports right in front of me that I'm going to jump back into right after the webinar, and taking a look, and sure enough, that old acronym and abbreviation, it's all over the place. And also remember to change all occurrences of the old name, including in bond official statements, on your website and other references, even in your budget. You really should change those references. Now, some governments implement it early, and that's awesome. Now, don't think that you need to go down the road and reissue all your old reports. No, don't do that. All we're doing is changing the name on a go-forward basis. Just leave those old reports be. Now, for auditors, failure to follow this new GASB standard could result in a modified auditor's report. If you think about it, it is a GASB standard. It is GAAP, and if the auditee decides for whatever reason not to change the name, it is a failure to follow GAAP. Now, what happens there? You have a modified auditor's report. Now, further, if the preparer is a CPA, well, the preparer might risk an ethics violation. So it's a fairly big deal on this one. For the GASB, every reference in GAAP needs changing, which is really a tall task. All references to the old name need to be redone, and the old name has been referred to, since 1979. And if you think about it, back in 1979, I had hair and it was black, and we were all listening to the Bee Gees back then and Saturday Night Fever. And that's how far back it goes. John Travolta was a fairly young guy back then, back in 1979. And that was the first instance in GAAP where the old acronym was referred to. So this is a pretty huge change. Now, because of this huge change for the GASB, they did not take this change lightly, as they considered 30 different alternatives. Also, one thing to note, if you do read the comment letters on the GASB's website, Some of them contain a ton of what I would call nasty language that's on there. Folks, this is accounting. If you do send a comment letter into GASB, just realize that they are published. And you know, a couple of, I've seen comment letters other than in this one where there's been redactions because of various words and so on. Come on, this is just accounting. Let's just get through this. But they did consider a lot of alternatives from stakeholder organizations. So with that, let's get to our next polling question, just to see what you're doing.
All right, we'll leave this open, but right now we're sitting at 41% in annual comprehensive financial report.
Yep. Yeah, so there'll be some changes you're going to have to go through on this one. And so don't take it lightly, that's for sure. All right. So now our next GAAP to implement is also easy, but certainly not as easy as the ACFR for GASB Statement number 98. This one, accounting for interest costs incurred before the end of a construction period, and that title is very apropos. It tells you the scope of what's going on, tells you what you need to think about. Again, we're talking about before the end of a construction period, not after the construction period. So pretty easy to think about. So for those of you that do have construction projects that are accounted for in enterprise funds, once you implement GASB 89, your life becomes so much more simple. No more capitalizing interest. Interest expense remains just an outflow. You know, capitalizing interest, when I was a preparer, it was always a thorn in my side. And certainly when I work with governments as a preparer or as a consultant, you know, in those governments have long-term construction projects or governments that pool capital outlays and issue consolidated debt for many projects, figuring out what portion of interest expense to capitalize during construction, it is a tall task. When a government issues consolidated debt, it's next to impossible to fairly state the amount of that capitalized interest tied to a particular project without a bunch of estimation and allocation. Now, back when the GASB was deliberating what became GASB 34, and I can't believe, you know, we're not talking 1979. We're talking about 20 years later, but still, it's a good 2 decades plus ago. When they were deliberating that major standard, this is one that I really fought against as I was a preparer for one of those governments that issued consolidated debt. Just to show how difficult it was, at one of the task force meetings, I brought a 3-inch binder with printouts attempting to allocate interest using that old beloved program, Lotus 123, and we had a major construction project going on, and I was trying to allocate interest costs from multiple debt issuances for that particular construction project, which was a multi-billion-dollar construction project. And I had a 3-inch stack of paper of numbers trying to figure out what the capitalized interest would be. Now, finally, after nearly 20 years plus, the GASB is providing some relief, which I really, really am thankful for. This one is implemented again prospectively. Do not change your beginning balances, as any interest that was capitalized is likely long depreciated. If we all remember the effective interest method, the first thing you depreciate is interest. And the second piece is principal. So using the effective interest method or even straight line, that capitalized interest is long depreciated. Now, for 2021's interest, remember, you're going to have to do a reclassification entry on it from the start of the year, from construction and process easy to do. Just credit to construction and process, debit interest expense. And again, only in enterprise funds or on the entity-wide financial statements. Now, if you have capitalized interest built into rates and charges for internal service funds, or you charge federal awards for interest expense, this is a little bit of a sticky wicket on you. Take another look at how those rates and charges are established, or the cost recovery from federal awards is claimed. You may need to adjust those cost allocation plans because it will no longer be GAAP on a go-forward basis. You might have an over recovery, in which case you just adjust it on a go-forward basis and adjust your next federal grant award draw. You may also need to let your federal granting agency know that there is this change in GAAP that is going on out there. So just take a look. Okay, our last standard this year is GASB Statement number 93, replacement of interbank offered rates, or IBORs. That is not Igor, it is IBORs. Maybe I should have inserted a GIF here from Young Frankenstein or Young Frankenstein, for those of you who are Mel Brooks fans like I am. Let's talk a little bit about this. This one has been under the radar for a couple of years. And you know, the GASB has been talking about this one since 2008, because for those of us who are of a certain generation, we remember the Great Recession. And we realized that there was a major fraud that went on, and one of the things that occurred during the Great Recession was this discovery of a price fixing that was occurring between banks in London to set the rate that we know as Libor, the London Interbank Offered Rate. And after the fraud was discovered, the various central banks of the world, including the Federal Reserve, got together to better regulate the setting of interest rates by commercial banks. And there was a major decision to sunset Libor 4 years ago. However, that date was put on hold because once they figured out that, gee, we got to sunset all these contracts that reference Libor, these banks realized, oh boy, we have trillions of dollars of these contracts out there, ranging from derivative instruments to leases to home mortgages that are based on Libor. So you can't just change these things overnight. This is a pretty important standard. And then they started down the road and then stopped, and then COVID happened. Now, GASB 93 currently does apply to contracts involving Libor. That reference to Libor is supposed to sunset after June 15 of this year, so starting on July 1st. So any new contracts issued by, say, swap providers or mortgages or other investments that reference Libor were supposed to sunset on July 1st, for example, or on June 16th of 2021. Whether or not that happened I haven't gone down into individual contracts in a couple of weeks. I haven't looked for it, but it should have stopped referencing Libor since then. Now, I've thrown a bunch of jargon at you. So let's get through some of this jargon. Again, Libor is the London Interbank Offered Rate, which is used for adjustable rate contracts, including mortgages, derivative instruments, and leases, just to name a few. Now, my home mortgage adjusts by Libor plus a factor beginning in 2027. And so far, I haven't heard back from my bank if they're going to change yet. And of course, we have COVID going on, and Libor is not at the top of their list. I mean, when I refinanced my house, I pretty much stuck the landing on that one at the low point of interest rates last March. And they said, oh yeah, we'll go to Libor. And I said, yeah, do you really want to go to that because it's supposed to sunset? And they said, yeah, we'll worry about that when it sunsets. And I said, it's supposed to sunset in about 14 months. And they said, well, we'll get to 2021 when we get to 2021. And so sure enough, haven't heard from them since, which is fine with me because it's pegged at Libor plus a factor, which is pretty darn cheap right now compared to the way interest rates are running. Now, Libor is a basket of 10 currencies with 15 separate maturities ranging from maturity overnight to maturity tomorrow to way up to 1 year. Now, even with inflation, those rates are pretty minuscule right now. Tokyo has its own IBOR, and the European Union has their own IBOR. But just in these three rates, $350 trillion in contracts, the last time I looked a couple of weeks ago, are at stake here. And now you know why this is important. Part of the agreement to sunset Libor was to allow central banks to establish their own highly regulated rates. Now, the Fed did just that and began to publish their own structured overnight rate in 2018. And it's called a SOFR, structured overnight financial rate. Now, I said SOFR, not SOFA, and I know I have East Coast accent, so it's SOFR. However, a SOFA is used to hide money in, and I know that's what some of us are doing these days, given the level of cash in circulation. Now, speaking of that, by the way, I was watching a presentation by Dan White of Moody's Analytics prior to Thanksgiving. And he said that the level of savings by Americans right now is at a record. We're sitting on 4 times the amount of cash right now than we were prior to the pandemic. Now, think about that for a minute. That's a lot of cash in our sofas. And maybe we can talk about that in another webinar someday. But those of us who are saying to ourselves, gee, why did inflation happen? And let's leave politics out of it. But a piece of that reasoning why inflation happened is we're sitting on a lot of cash right now because there's just a lot of uncertainty what's going on. Okay, let's get back to GASB 93. Now, due to the change in Libor, contracts are going to have to change, but the key is not to trigger a gain or loss from that change. Prior to GASB 93, any of these changes may have triggered a gain or loss. Now, when GASB 93 is implemented, if the rate reset timing or the frequency is the same, so let's say it's going to change every day or every week or once a year, when GASB 93 is implemented, the rate reset timing, if it's the same, then no gain or loss. If the date of the month or year of the change it is the same, then again, no gain or loss. So let's say the interest rate is going to be changing every 15th of the month of the first business day after the 15th of every month, then there's not going to be any gain or loss. If the pattern or method of the change is going to be the same, or the dates of the payments are the same, well, you get the general idea here. No gain or loss. And this is a good thing. I mean, the GASB has given a lot of wide latitude to allow us not to trigger a gain or loss. And I know you may not be directly involved with this, your treasurer may be involved with this, but this is one thing that they're really taking a hard look at in all the contracts that they're working with, from derivatives to bonds to you name it. Now, if terms are consistent, then again, no gain or loss. Now, I mentioned a few minutes ago, even with inflation, the interest rates we're talking about here are tiny. And I looked a few days ago, we're talking less than 0.25%. Actually, this is from October 27th. But even so, even with the interest rate rise that you see on the right-hand side of your screen here, it's still minuscule. We're still way below 1%. The ones I looked at last week range from 0.08 to 0.1%. But daily volume in the New York Federal Reserve was over $74 billion. And that's just one central bank. And those are daily volumes in LIBOR set contracts. It's $74 billion in one day in one central bank. So this is a fairly big deal. Prior to September, the International Currency Exchange Benchmark Administration, or IBA, they had a plan to sunset LIBOR on taxable debt by December 31st of 21. Now, the IBA is that central authority that I mentioned of all the Federal Reserves, so to speak, all the international Federal Reserves. They're the folks who are regulating this changeover. But they were supposed to sunset in September, but then we had the Delta variant. And it's now been extended to June 30, 2023. And again, we're just kicking that can down the road. Who knows if this thing will go beyond January 2023. Now, if you do have a contract that references LIBOR, again, derivative instrument, leases, mortgages, and in most instances, you might not have a gain or a loss triggered by this change. For hedging derivatives instruments and swaps and so on, you can continue deferring those gains and deferring those losses as deferred inflows and outflows of resources if you meet this criteria on the screen. Now, you may want to dog-ear this page. I'm not going to read this to you, obviously. Bottom line, the replacement rate needs to calculate to the old rate somehow, some way, not to trigger a loss, even if the rate bases are totally different. So dog-ear this page. If you have a hedging derivative instrument, you may want to take a look back at this at a later point. Now for something completely different beyond GASB 93, because guess what? That's all you need to think about for this year. So let's take a look at something completely different. This is going to be the new independent auditors report. Prior to COVID, I just hit something funky. There we go. Prior to COVID, the AICPA's Auditing Standards Board issued this massive statement, SAS 134, auditor reporting and amendments, including amendments addressing disclosures in the audit of financial statements. 3 sections of auditing standards were replaced, and a new section was introduced. The replacements include sections on the core auditor's report, which is AUC 700, the section on modifications to the auditor's report, which is AUC section 705, and the section on emphasis of matters and other paragraphs in the auditor's report, and that's in AUC section 706. All of those sections are now being replaced. There's a brand new section in reporting called AUC section 701, communicating key audit matters in the independent auditor's report. Now, I'm going to get to that in a second, but before you all start going nutty on, gee, this brand new section, that communication of key audit matters, it is purely optional. Doesn't mean you need to go asleep for this one, especially if you're studying for the quiz, as I used to call it, the CPA exam, because you're going to need to know this if you happen to be one of those folks studying for the exam. It is purely optional, but your governing board may be interested in these key auditing matters. There are going to be conforming changes and related leases from the Auditing Standards Board that cover the AUC Section 260 letter, which is that communication letter us auditors write to your governing board. ERISA plan reports, the pension and OPEB schedule reports, and reports on government auditing standards. All of these are going to have conforming letter changes. Now, there there is a final release within this suite from SAS 134 to SAS 140. There's a final release on conceptual changes to calculating materiality. Now, that's just for auditors. I know I get a lot of questions every day. Gee, can I set a materiality threshold when we implement GASB 87 for leases? Well, that's something for a different webinar. What we can talk about that as we go through the winter and spring webinars about it, about setting materiality and how it's not as easy as you think, because you have to consider not only quantitative but qualitative materiality. But this particular release is just for auditors, not for preparers. Now, these are effective for reports after December 15th of this year. Now, by my brand new watch, that looks to me like 2 weeks from yesterday. So this is here. It is happening. So let's get to business here. The auditor's report again will change. And again, for those of you studying for the quiz, you need to think about this. You have a new report to memorize. You know, gosh, I remember trying to memorize every single word in the auditor's reports when I took my quiz, and it just was not fun. And so now you're going to have to think about the new unmodified report. The opinion section, well, that's going to be presented first, followed by the basis for opinion section. The basis for opinion section will include the statement that the auditor is required to be independent and to meet ethical responsibilities that are relevant to the audit. Now, on the scant chance that your government is a going concern, and it's pretty rare out there, there is an enhanced reporting element in that section. There's also an expanded description of the auditor's responsibilities relating to professional judgment, professional skepticism, and the communication of those charged with governance. Most of what the resulting report is what I would describe as a rearrangement. The lead story is no longer buried. You know, one of the things they used to say in writing a newspaper story is don't bury the lead. Well, the audit report has finally caught up to that don't bury the lead. It's now first up top. It doesn't mean you shouldn't read the rest of the auditor's report, but it will be the first thing that is described. And again, that is that top bullet on the right-hand side. So this is what the new audit report will look like. First, the opinion paragraphs, and then the basis for opinion paragraphs. Now, this is the wording for general purpose governments with an unmodified opinion. A few changes in the individual paragraphs, only really the locations, the geography has changed a little bit. But if you take a look, we're starting off with a report on the audit of the financial statements, and again, the opinion paragraphs, and then how we came to our opinions as auditors. Next is the responsibility of management paragraphs. Notice the language. Again, preparation and fair presentation of the financial statements, design, implementation, and maintenance of the internal controls, and so on. Not much has changed from the existing auditor's report. And then there is the paragraph on evaluating whether or not there is an issue of going concern. And then our responsibilities as auditors. Here's our responsibility. And other than the list of bullets, there's an emphasis about reasonable assurance, not absolute assurance, as well as professional judgment language that's here. And I know this is pretty small on your screens, especially if you're looking at this on an iPhone or something like that. This is really small, but it'll be in your handout. Again, notice the bullets. Professional skepticism, internal controls, appropriateness of policies and procedures, and then going concern, which is that last bullet that's there. Finally, there is a communication section, which is that bottom paragraph. And then we head down the road of required supplementary information, and other information, just like the current reports. And here's the other information here. Again, just like the other reports that are there. And then the other reports on government auditing standards. And finally, the signature and date. Now, the final paragraphs here, not many changes from the old auditor's report. Okay, let's cut to the chase. Okay, I bet you're wondering, what's this deal with key audit matters or CAM stuff? Again, this is optional. It does not mean that we will be engaged to do this unless your governing board wants us to be engaged to do this. I Bailey would love to, be engaged by your governing board to provide this information. Obviously, it's a change in scope. Now, some governing boards may desire to have this information, and that's absolutely fine. The ASCPA has identified these 8 issues on the screen, which may be common to CAM's reporting. Now, one that may be most common to many of you may be investment valuation issues. Another may be estimates and uncertainties. And again, note that the GASB is going to have an exposure draft on risks and uncertainties that will be coming out next year. We may have to, in the distant future, start disclosing in our note disclosure our risks and uncertainties. And it's looking pretty good. The board will be deliberating some of the more fine points of what may be in the exposure draft coming up the week after next. But there's a lot of focus these days on risks and uncertainties. After all, we're living in a very risky and uncertain world. That said, should we be engaged as auditors to report on those to your governing board? That is going to be a big question. Your governing board will hear about these CAMs from other, similar governing boards. So just stay tuned. If they do ask and you want to reach out to us, please feel free to do so. But this is going to be becoming an emerging issue for you. So with that, let's get to our next polling question.
All right, we can leave this open, and we're sitting at about 40% with option B.
Yeah, I don't think my governing board. Okay, they might not have heard about it as yet, but as some of their peers start to engage on it, or maybe they're a more active board, they may say, "Hey, wait a second, I'd Bailey, come on in and kick the tires and tell us about what our key audit matters are." And go back to the previous slide, and you realize that it does pervade through a lot of your operations. If you think about every particular place where you do an estimate or there's risk, there's going to be a key audit matter that's there. And it might be a good idea to report some of those to your board, so maybe they'll make better decisions. So with that, all right. So what's in our bag of toys for next year? All right, we made it through this year. Now, if you're going through GASB 87 withdrawal, which I doubt, and you want to hear me and my fellow Eide Bailey team drone on GASB 87, you have plenty of opportunity. I mean, just here on the screen, that is 90 minutes just about. In that particular one, we actually got truncated because of a systems issue. And then we have one here that's almost 2 hours. And then we have the third piece, which is about 1 hour and 45 minutes. All this content is on YouTube. Unfortunately, it is not for CPE. But you can easily, Google this. And for those of you who are in the northern regions of America, the first blizzard, instead of watching the U-log, why not watch GASB 87 webinars? Come on, you can do it. It is just as fun as watching the U-log. Again, unfortunately, no CPE on playback. Of course, I'm saying to myself, do I sign up for Disney Plus and watch the Beatles or watch Eric Berman do GASB 87? Which one should I watch? Which one do I want to be a glutton for punishment on? Well, anyway, but there's plenty of content out there just for you. And I do hear of people who have watched the YouTube sessions and asked questions. So don't think you're the only GASB geek on the planet. And wanting to hear all about GASB 87. We do have plenty of content on our website on GASB 87, and we're going to be doing more stuff for you coming up in 2022 as you implement. So no GASB 87. It is a GASB 87 free zone today. All right. Now, the biggest deal for some next year is GASB 91, which is conduit debt obligations. Now, for December 31st governments implementation of GASB 91, it begins on January 1st as the ball drops in Times Square. Everyone else, it is on July 1st of 2022, but it is going to be an important standard that is out there, as it may change the way many borrowers report debt. GASB 91 replaces current standards that are nearly 30 years old, and in fact, a lot older, as the current standards were just a GASB interpretation of existing standards that were originally issued in the 1940s by the predecessor, probably two predecessors before the GFOA. I think it was the Municipal Government Finance Officers Association or something like that, but it was two before the GFOA that issued these standards. Now, what is conduit debt or a CDO? CDOs require at least three parties: the issuer, the borrowers, and a debt holder or debt trustee that manages the funds on behalf of the bondholders or borrowers. Now, typically the trustee is a corporate trust department in an investment institution such as Bank of America or something like that. A major change is that the borrowers and the issuers are not in the same reporting entity. Now, we find this often with finance authorities, for governments that issue debt. The debt is called the CDO, and often the bonds are cross-collateralized or parity bonds. And cross-collateralization occurs when one bond series collateralizes another. But long and short, if the borrower or the obligor and the issuer are in the same government or in the same reporting entity, well, then it's no longer conduit debt. Somebody is going to have to report this debt, and it's probably going to be the issuer. The corporate trust department receives the funds and manages the funds on behalf of the borrowers and debt holders. If all this is in place, then the issuer only has a limited commitment to repay the debt, as it's ultimately the borrower's responsibility. But again, all this stuff needs to be in place. If it's not in place, then the issuer has to report the debt, which is a big change for issuers. If it is on place, then it's a big change for obligors, which mainly are municipal governments that are out there, because it's ultimately the borrower's responsibility. So this limited commitment, it's a little difficult to understand, as she is showing on the screen. It's a little difficult to understand. An issuer's commitments associated with a conduit debt obligation can vary, and it's limited. However, the issuer can extend an additional commitment or a voluntary commitment of its own resources. And under an additional commitment, the issuer agrees to support debt service only in the event that the third party obligors are unable to pay their debt. Examples of additional commitments by an issuer include support of debt service payments, including extending a moral obligation pledge or extending an appropriation pledge or extending some form of financial guarantee, pledging of property, revenue, or other assets as security. Now, under a voluntary commitment, an issuer does not make an additional commitment but on a voluntary basis decides, you know what, we better do this. We better pay the debt service for this particular borrower or request an appropriation for a debt service payment because, hey, that borrower or that group of borrowers, they can't make their debt service payments. I put on the screen here state revolving fund contract assistance, and that is a form of limited commitment that's out there. And I know that various state revolving funds essentially buy down the interest rates on debt by municipal borrowers. After all, I issued 30 billion of that stuff when I was an issuer. If that's the case, that is this limited commitment that is out there. Now, whether or not that results in a conduit debt obligation is a different story. But all of those issuances will need to be analyzed as governments implement GASB 91. GASB 91 focuses on form versus substance. Now, you may be familiar with the term certificates of participation or revenue pledges or limited obligation bonds. Now, these terms don't matter a heck of a lot as much as what is the substance of these transactions. If the bonds meet the definition of a CDO, which I talked about a few screens back, then they are a CDO. And as such, guess what? If it is a CDO, then the issuer does not report the bond issuance unless they have some form of non-exchange financial guarantee. And we've been dealing with non-exchange financial guarantees since Statement 70, 21 statements ago. A few years ago. They're pretty well ingrained right now. But once you implement GASB 91, it's a pretty different story than what is going on today. Today, typically the issuer reports, and back when I was an issuer of debt during the 1990s, I figured since it was my name on the official statement, I better report that debt as an issuance in my government. And that's pretty important. This change is going to be pretty important for some governments that are parties to CDOs that meet the definitions and may have to implement GASB 91. And once they do, guess what? They're going to have to report debt that they never reported in the past. And that's a very big change. Accounting and financial reporting is going to depend on facts and circumstances to the CDO. CDOs should be financing capital assets, but I wouldn't put it past some government out there financing pensions, for example, using a CDO. I wouldn't put it past them to do that. In some cases, the asset will revert to the issuer. In some cases, the asset will be shared. The accounting is going to vary. Here are 3 scenarios you may want to review. Again, for issuers, if a CDO is in place, don't report the issuance as a liability. Don't report it as a lease. Don't report it as a receivable. Now, you may want to disclose the issuance, but it's not necessary. I'm going to take a swig of water right here. Yeah, you can disclose it in the note disclosure, but it's really not necessary. And so this is a very big change. Now, what do you disclose? Only disclose the general terms of what is going on, and if indeed there is a non-exchange financial guarantee in place. Now, for issuers such as state revolving funds, infrastructure banks, there's going to have to be some form of information exchange between obligors and the issuer that may not be in place right now, assuming there is a CDO in place. If you are one of those entities, you may want to start thinking about the internal controls over financial reporting and consider what is being done by, for example, statewide defined benefit pension plans and participants. That sort of information exchange between those entities may be like what is needed. Now, there may be an additional level of assurance as well, but as of right now, the AICPA has not weighed in on it yet. But if I were a gambler, I'd bet this sort of thing is going to be coming. Now, you're going to see a bunch of this stuff, potentially involved with public-private partnerships, GASB 94. Now, we talked about that in September. We're going to talk about it some more next year. So stay tuned if you happen to have one of these public-private partnerships that are out there. Be careful. Okay, so disclosure is simple on this one. Pretty straightforward stuff. Again, just a general description of what's out there. And if you happen to have, oh, why is this going backwards? If you happen to have one of the, some form of non-exchange financial guarantee, just disclose what is required by GASB Statement 70 or GASB Code Section N30. Very simple disclosure. The timing of recognition and measurement, the beginning balance of the liability, increases, decreases in ending balances, and amounts expected to be recovered from the payments. Okay. Boy, is it dry here on the East Coast. Not quite a desert, but it's pretty close. In any case, okay. The omnibus, as we know it, Omnibus 2020 GASB Statement number 92. Now, omnibus statements are correcting statements, and this one is no different. Yeah, this is another one of those sleeper standards that have been out there and lost during the GASB, the COVID haze, but no longer. Now we got to go implement this one. Now, this really is a cleanup standard. 3 aspects should have already been implemented, but 5 may still be in process at your government. Reporting of intraentity transfers of assets between a primary government employer and a component unit defined benefit plan. That could be still that's out there. The applicability of GASB Statement number 73. You thought we were over on that one. Really aren't. GASB Statement number 73 and 74 as to how do you report assets accumulated for post-employment benefits, but what that really is a slight amendment of GASB 84. The applicability of certain other requirements of GASB 84 to OPEB arrangements. How do you take care of non-recurring fair value measurements of assets and liabilities? But that's really just a textual change in the codification, a reference change. So again, it's one of those cleanup things. And then measurement of liabilities and assets, if any, related to asset retirement obligations in the case of a government acquisition. Those are really the low-hanging fruit that is within Omnibus 2020. It really is a cleanup standard. Again, some of these may have already been implemented and probably not even applicable to your government. A lot of it is text changes and not really pervasive. For example, derivative instruments and changing things to that word instrument is a global change that's been made in many financial sectors. So it's pretty easy peasy to do. And again, some of these are just clarifications as to what's going on in GASB 73 and GASB 74, as well as fair value. Now, the one that is probably most controversial is the intra-entity transfer of assets, especially now with governments if they face budgetary challenges. It really depends on the individual situation. Governments are considering if it's possible to contribute, income producing non-financial assets to defined benefit plans to solve some form of funding shortfall. Governments are getting a little creative and saying, gee, can I contribute this building to my defined benefit pension plan? Well, yeah, maybe no. Now let's break it down a little bit. Non-financial assets can be contributed to that DB plan, again, if the law and the economics are right. Now, if the government contributes capital assets to a DB plan, GAAP will require that the assets be valued at carrying value in the transfer, net of any form of consideration, either a lump sum or a stream, to arrive at whatever that amount is. And any other assets should be required to be income generating to pay benefits. So we're talking the New Jersey Turnpike and not the New Jersey Lottery, which was contributed to the New Jersey pension plan, but it turned out to be a rotten deal for the state of New Jersey, because municipalities in New Jersey were entitled to all the net profits from the lottery and not the pension plan. Another problem is once the assets are gone at a local government and not generating revenues, they're gone. But if so for example, let's say you contribute a municipal utility, that might work. But if the municipality relies on the revenues from that utility, that's going to be a problem. Further, if the plan may not want to be saddled with asset retirement obligation from that utility or other long-term debt. And again, you have to have an existing law to allow such transactions. My advice, only do this as a last resort. Okay, now we're at GASB 97, which is definitely not overlooked. I get lots of calls on this one. Now, what does GASB 97 do for relationships between a primary government and an employee benefit plan? Well, first, you got to have a potential component unit. And if the primary government performs duties that a governing board performs, then absence of a board is the same as appointing a voting majority. Now, how does this work? Let's say you got a defined benefit plan held in trust at a city. The city council instructs the city treasurer, says, okay, you are now a board. You're now the board. But that would be a voting majority. But there are major exceptions within GASB 97. GASB 97 excludes this step if a potential component unit is either a defined contribution, different, defined contribution, pension or OPEB plan, or an other employee benefit plan, including certain but not all Internal Revenue Code Section 457 plans. That word certain is italicized for a reason, because it's vital. It's not all 457 plans, because there's a handful of 457 plans where it comes back into play. We'll talk about those in a minute. Given this change in 97, the only thing that's left for this potential component unit analysis, and again, we need that potential component unit, is potentially defined benefit pensions and defined benefit OPEB, external investment pools at states and many counties, and other non-pension or OPEB potential component units. But we have to test that component unit relationship first. And if we don't have that relationship, then this doesn't apply. We have to get to that component unit relationship. If we don't have the component unit relationship, then we got to go back to GASB 84, because GASB 84 is still out there. Second, there needs to be, again, that potential component unit relationship, and then we go down the road of financial burden, but that's only applicable if you happen to have defined benefit pension or OPEB plans administered through trusts. If you do not have a trust, it's likely that no component unit relationship, but you may still have a component unit for other potential fiduciary activities. So do the kicking of the tires. Don't forget about all those other non-pension, non-OPEB potential component units that are out there. Here's the all-important spaghetti chart. We saw this back, I think it's September. I think we saw it back in May of this year. So this is really old school. I had to take another swig of water here. Take a look at these changes provided by GASB 97. Again, there has to be some form of legal separation, and the best way to do so is using an irrevocable trust in the case of many benefit plans. Now, the majority equity interest provisions, again, in most cases with 97, they're just not going to apply. but we still need to understand that there could be a majority equity interest out there for non-GASB 97 stuff. So then we go over a little to the right here and we go back over to the voting majority of the board decision, but it only applies to defined benefit plans or external investment pools. But if we have a defined contribution plan relationship, we got something different. We skip that voting majority of the board decision. To be a component unit that's fiduciary in nature, then there'd have to be some form of fiscal dependency and that's this third yellow box here, or there needs to be some form of misleading to exclude provision out there. Both of these elements on the right-hand side in the center are going to be pretty rare in practice, and chances are it's not going to be a component unit. Okay, I use that word trust out there, and a lot of us forget what it means to have an irrevocable trust. Think of those magic words: irrevocable, dedicated, and protected. The contributions must be irrevocable. You cannot take the contributions out other than to pay benefits or to pay plan expenses in accordance with your plan document, or maybe provide loans depending on your type of plan. Second, the assets must be dedicated to providing benefits. And this is straight out of the IRS's exclusive benefit rule, IRC 401A2. That rule is key. I was reading a set of financial statements last week that said, gee, they got a court case going on where they have petitioned the IRS to take a look at the exclusive benefit rule. That's a very big deal. And they're wondering whether or not their plan violates the exclusive benefit rule. It is absolutely key. It requires the plan to be maintained for the exclusive benefit of employees or their beneficiaries. And under that trust instrument, it be impossible at any time prior to the satisfaction of the liabilities. You can't divert for anything other than to pay administrative costs and to pay benefits. That's it. Now, the asset must be legally protected from creditors, meaning in a divorce situation, bankruptcy, legal trouble for the government. These assets can only be used to pay for benefits. Now, yeah, in the case of a divorce situation, if you have a qualified domestic relations order from a judge, that is allowable. And it doesn't mess up the trust. But without all three, you do not have an irrevocable trust. Now, the bottom line on fiduciary component units, if there is an irrevocable trust, there is legal separation between a primary government and let's say you have a single employer DB or DC plan, the separation is there, and you probably do have a trust. Chances are you got a component unit, but on DC plans, you got to be a little bit careful, especially if you don't have any benefit or burden. That said, these equivalent arrangements, and I mentioned the word equivalent arrangement on trusts and equivalent arrangement. That phrase, it really depends on the language and law or the regulation ordinance that created that arrangement. Now, for multiple employer plans, the component unit tests apply. But if there's no component unit relationship, then the remainder of GASB 84 and 97 apply. Now, it could be that many of these plans may not be reported by primary governments unless the plan is somehow, some way administered with a defined benefit plan. And usually you have these things called Section 115 trusts, where the government has control over the assets in accordance with GASB 84. And there's some form of allocation that goes on between, say, the DB plan and the DC plan. Now, if you do happen to have one of those, you may want to give us a call and we can talk through that particular language. Now, there is also a change that's out there, which we'll be implementing together this year, and that is on this word control. And I've talked about this in other webinars, and this is just a revisit, given the fact that, hey, we're all dealing with a lot of stuff and we may have forgotten about this one. In the implementation guide update for 21-1, question 4.3 is a huge question. And it really clarifies a lot of GASB 84. It clarifies a lot of 97. That was really hard to understand. And the bottom line is, in many situations, the government may not be in control if the individual can direct when assets can be bought or sold, even from a slate of investments. No, selecting the set of investment options means that the government is not in control. And the impact on this may be huge. You know, self-directed plans and similar might not be fiduciary activities. There would be no change in your government's relationship for a DB plan, a defined benefit plan like a PERS or a STIRS, but for all other employee benefits, including deferred comp, that's probably not a fiduciary activity. And I get a ton of questions on these. As to whether or not a 457 plan is purely deferred compensation. Well, if it's in the same report as your government, and you want to keep reporting that 457 plan for whatever reason, I really advise you not to do it, because if the participants have control over those assets, no reason to report it. You're not in control. If you really want to have a report on a 457 plan, just issue a separate report just for the plan, separate audit, separate materiality, and so on. But if the government seeks a little bit of accountability over that plan, well, that's a pretty small price to pay, the cost of that audit. Now, this impact, this is a real situation. And I know I've talked about this before, but again, 10 times for the normal mind, 100 times under stress. Here we got a county. We have a separate DC plan using an irrevocable trust that has all the required elements. And the DC plan is out there in addition to the county employees being eligible for the statewide PERS plan. Kind of a familiar situation. We have no board in the DC plan, but we do have a third-party administrator, the local bank, and that county contributes based on somebody's age and length of service. However, the employee can direct the investments to a TPA, even though the county established the investments that may be bought or sold. And here's the result. Yeah, we got some legal separation going on there. But we don't have to go down the road of a voting majority as the county commissioners serve as the board. Is there a financial burden? Well, yeah, but we have we have exceptions in GASB 97. Is there fiscal dependency? Well, if the administration is by the county, yeah, but we do not have control. So not a component unit, no reporting by the county other than the outflows for employee benefits from payroll. Okay, but wait, there's more on GASB 97. We still have some aspects of it to go. Remember, 457 plans have had some issues since the 1990s when the original GASB 32 came out. If you read the Internal Revenue Code, Section 457B describes these plans as deferred compensation plans. Now, most plans we run into in practice are just employee withholding, but some governments have thought they were in control, while others thought that since the funds were employee funds, they're not in control. And those governments felt they were not in control, thought they were not even pension plans. But GASB 97 will change things, and it will end the chaos. First, a 457 plan of any type, they need to meet the definition of a pension plan to be reported. So what's the definition of a pension plan? It's right here on the screen, and this is straight out of GASB 67. An arrangement through which pensions are determined and assets are dedicated for pensions are accumulated and managed, and the benefits are paid as they come due. Whew. If a 457 plan does not meet this definition, it's just some other employee benefit plans, and then go back to GASB 84. And if there's no control, no reporting. Now, there are a handful of 457 plans that are out there that are defined benefit, but those are darn rare. If so, those would be reported just like pension plans in accordance with GASB 68. Okay, let's go revisit that nightmare. Okay. But in most cases, they would be defined contribution plans, except for those rare DB plans. If there is a 457 plan that is a DB plan, please call me. And I'd like to talk to you about it. And let's walk through the provisions. And chances are it's not a DB plan. So in making these decisions, don't get caught up in the Internal Revenue Code and so on, like 403B and 401k. Don't get caught up in that. Go through the process to of what we've been doing with GASB 84 and then document your decisions. Putting things all together, implementation is pretty much now. We've had another year to report under GASB 84. Most of our governments have implemented GASB 84, fine and dandy, but implementation of 97 is now. There may be some component unit adjustments because of 97. And in 457 plans, remember, you might have a restatement that is going to be needed in those really, really rare circumstances. If your government has implemented GASB 84 already, take another look at those DC plans or other employee benefit plans. And as you can tell, this is just not going to be easy. If you do happen to have one of these, that you may cause a restatement, even if you already implemented GASB 84. Again, don't look at your neighbor. Just because they reported a DC plan or a 457 plan does not mean that you should be reporting it. It's going to be a little bit of a challenge to go through and just take another look. And that leads us to another polling question.
Well, while they're answering, there is a question here. It says, what does vital legal mean?
Okay, what does vital legal mean? I don't remember saying that. I must be I must be hallucinating. Okay, all right. Taking it might have been in the context. I'm looking at the time. It might have been in the context of 97. Take a look at your legal aspects of how the DC plan was established. Certainly email me separately. I might have forgotten what I was talking about. And could be running on the mouth today. I guess so. Anyway, yes, email me directly on that one. All right. So with that, let's plan our future. I know I'm already getting junk mail saying, Eric, why not come back on a cruise in 2023 or 2024? Come see the world. Well, let's talk about planning the future in a little bit. Here, hang on, let me get this off my screen. All right. There are going to be 3 standards that are going to be issued over the winter and early spring, and that we have time to talk about today. There's probably going to be a few others coming later on in 2022 and 2023. Comp abs, accounting changes, error corrections, and Omnibus 20XX, which will likely be 2022. Now, compensated absences. This one may be out again in a few weeks, but there are some rumblings it might be delayed. If it's released in a few weeks, it might be GASB 99. The new standard, it's going to be updating 30-year-old provisions of GASB Statement No. 16, accounting for compensated absences. Now, the GASB is finalizing exceptions to the general recognition requirements. And these exceptions include, whether or not there's some form of leave that is dependent upon an occurrence of a sporadic event that involves a small proportion of employees in any reporting period, which may not be recognized until the leave begins. And you know this better as parental leave, military leave, jury duty, and is there a liability that needs to be recognized for that? Then you have the other side of the coin, which the board is going to be deliberating over the next few weeks. There's an emerging practice of unlimited leave, which you get effectively a basket of unlimited amount of hours off, as long as you use them within a particular time period. The question is, okay, when do you recognize those hours off? Are they recognized when taken or when they're accrued? And then, of course, holiday leave. How are those recognized? And so the board still has some twists and turns on this one. There are 4 issues likely in the standard: when to measure the liability, what transactions are included in the liability, what about the current portion of the liability, and what do we put in note disclosure. What will be included in the calculation? Effectively, it's the cash flows we're using now. However, the liability may be recognized sooner than what we're doing today, because we're going to be going from a probable threshold, which most practitioners think is 75%. We're going to be going down to a more likely than not threshold, which we know is described as 50% plus a feather. This could increase our compensated absence liabilities. In return, a major change in note disclosure will now allow for the netting of the additions and deductions in that table we all know we fudge, where we do our beginning compensated absences, and that beginning number becomes our deductions, and our ending compensated absence liability, that becomes our additions. Well, guess what? The GASB knows as well that we've been fudging this one since the 1990s. And guess what? They're going to allow us to net those additions and deductions, which is phenomenal. Thank you, GASB, on this one. Again, we're talking periods beginning after December 15th of next year. So this gives the actuarial community a little bit of time to make the change, but this change is coming. It's going to, for you December 31st out there, probably January 1st of 2023. Okay, this is where the GASB hits the century line. GASB 100, when it's issued late winter or early spring. Probably 4 major areas of changes, most notably clarifying what's in some terms and leases, for those elements, those implementations would begin after next June 15th. Some elements would be immediate and others would be delayed for about a year. But let's get rid of the easy peasy stuff first. GASB 70 non-exchange financial guarantees would be expanded to an exchange financial guarantee, to which I said to a GASB board member, now tell me, do they exist? Does an exchange exist for a financial guarantee? And they couldn't point to one. And I certainly have never run into one in practice, but somebody wanted this done. And I don't know why, but the board is headed down this rabbit hole. Also, there may be a creation of a third type of derivative accounting. Again, I'm not sure where the problem is here, given that I was on the task force for what became GASB 53, 64, and 66, involving derivatives. If it's not a hedge and not an investment, then what the bejeebers is it? If it's not a hedge, not an investment, what kind of contract is this? The most important items in this easy stuff is again, Libor references, maybe better disclosure of this mongrel transaction that's a poor stepchild, the non-monetary transactions. Quite frankly, I've always seen disclosure of non-monetary transactions and land swaps. Everything else has never been disclosed in my entire career of working with governments. Okay, so then what's in the lease framework? Here are the proposed adjustments that they would apply to 5 areas of the framework. And as you implement GASB 87, look at these as and see if you need to make a change in your situation. The biggest change may be the short-term leases that are out there. If there's a reclassification from a short-term to a long-term, if GASB 100 goes through, you may have to start over on short-term leases. So let's say you got a short-term lease and you excluded it from your GASB 87 calculations, and then you decide to extend. And let's say you decide to extend for another 3 years. Well, then you need to start over and re-amortize. Could it mean a balance restatement? Well, it depends on what the final language will be, but the board is still deliberating on this one, and it is controversial. Now, the other elements are going to be involving calculating liabilities and receivables, definitions of incentives. Again, stay tuned on this one. There are a few issues that the board is going to need to consider over the next few months. Okay, our final standard of the day. This could be GASB 101. This changes 70-plus-year-old GAAP. The board is still doing some serious deliberations on this one, including whether or not creating a fund causes a beginning balance restatement. Please, GASB, I hope not. But I think that might cause a balance restatement. I don't know what the board is trying to achieve on this one, but unfortunately, it might do so. Changing from major to non-major funds, that could cause a balance restatement. Note disclosure elements are also still controversial, as would the restatement of RSI. The restatement of RSI, that generated a lot of comments. That could be interesting. A lot of folks, they do have restatements of RSI every so often, especially those pension and OPEB schedules. And there is no GAAP right now on restatements of RSI. But do we have to go all the way back to 10 years schedules? I hope not. We may be looking at a FY 23 and 24 implementation. This is probably going to be GASB 101. Well, with that, let me just take a quick back look through Vital Legal. Oh, component unit chart. Okay, Mr. Sharp. Okay, if you go back and take a look at the component unit chart, and I'm going to go back here. I can go back a few. This legal separation is really, really, really important. A lot of folks swear to God that departments are legally separate, and no, they're not. The word vital was trying to emphasize that there needs to be a legal separation in accordance with GAAP. And if there is no legal separation, it is part of the primary government, and it's just like auditing another department or presenting another department. Now, if there is no legal separation, but the primary government does not hold the corporate powers, then, hey, for some reason, there's a mongrel entity out there that is not part of the primary government. But I've never seen the two no branches together. I've seen a no and then a yes. I've never seen a no and a no at the top of the list. So thank you for clarifying that. You're a gentleman and a scholar, sir. All right. And I don't see any additional questions out there. The new independent auditor. Oh, here's another one. Confirming that the new independent auditor's report is for reports issued as of December 15th or later, regardless of year end. That is absolutely correct. It is December 15th or later. If that date of the report is on December 16th, new auditor's report is supposed to be there. Okay. Other than that, let's see. Somebody asked, what would a CAM in a government serve to achieve? To alert your board to its risks. Think if we had CAMs reporting on a public health department 3 years ago that it was woefully understaffed. Potentially, and again, I'm not talking politics here because I'm apolitical. Think of how better prepared a government may be with PPE and things like that, or having a stockpile of vaccines. You never know. You never know. All right. That's about it. All right, let's go back into the deck here. I think those are about our questions for this year. From my standpoint, I know we're at the bottom of the hour. I want to thank you all for this year. I've really talked to thousands of your peers. This year has been really special, and Ide Bailey really thanks you for your support this year. Have a happy, healthy, and safe holiday season, everyone, and let's work together and make 2022 far better than 2021, and let's be at peace this year. Thank you all again.